Welcome to the Deep Dive, the show where we take a stack of your sources and distill them into the most important nuggets of knowledge, helping you get truly well-informed, fast. Today, we're plunging into a story of incredible transformation and high-stakes potential. It's one that might just redefine how you think about digital infrastructure. So the big question, is Core Scientific a relic of the crypto winter? A bankrupt Bitcoin miner getting a temporary lifeline from the whole artificial intelligence frenzy? Or is it maybe one of the most misunderstood, perhaps undervalued ways to invest in the AI infrastructure boom? A company whose most valuable asset isn't the coins it creates, but, well, the raw power it controls.
And this deep dive, I think it'll show you that the answer, and crucially the future valuation of this company, it lies less in the code of the blockchain and much more in the megawatts flowing through its cables. We'll explore an estimated intrinsic value range that frankly sits significantly above the current market price. But we also need to unpack the really high stakes risks that come along with it. It's a story where, the old meets the new and the future is being built on some pretty surprising foundations.
Exactly. Our focus today is Core Scientific, Inc., ticker symbol CORZ. And this analysis is based on info available as of June 26, 2025, anchored to its closing share price of $12.30 on June 25th. The central theme, it's this profound strategic shift, moving from being, mainly a crypto miner into a diversified digital infrastructure provider with a big focus on high-performance computing, HPC, and of course those widely reported, maybe imminent acquisition talks with the AI hyperscaler CoreWeave.
Yeah, that CoreWeave angle is huge.
So we're going to tackle this deep dive in two main parts. First, we'll get into the fundamentals, the business itself, management, financial health. Then we'll shift focus to market sentiment, who owns the stock, and a pretty thorough risk assessment. And throughout, we'll be announcing distinct chapter titles, just to help you navigate this pretty complex story. Okay, let's unpack this with chapter 1, business analysis.
Right. So Core Scientific's business model, it's really undergone what you can only call a seismic transformation, a huge shift. They've moved from being almost entirely dependent on Bitcoin's, let's face it, volatile fortunes, to becoming a much more diversified digital infrastructure operator. And this is the single most important factor to grasp about the company today. It's a deliberate pivot, not just drifting along.
And you can really see that shift in their Q1 2025 numbers. They've basically got 3 distinct revenue segments now. First, there's digital asset self-mining. That's the legacy business. Their own huge fleet, about 156,000 machines, mining Bitcoin. It brought in $67.2 million in Q1 2025. But here's the key thing. This segment is deliberately shrinking as they reallocate.
Right, that's the plan.
Then there's digital asset hosted mining. Here, Core Scientific is more like a landlord. They provide the facilities, power, cooling support for other big miners. That chipped in a stable $3.8 million in Q1. It's a service-based income stream.
But the really critical future segment, the one driving this whole transformation, is colocation, specifically for high-performance computing, or HPC. This is their high-growth engine, serving those cutting-edge AI and machine learning sectors. We're talking long-term, dollar-denominated contracts here. Much more stable. It generated $8.6 million in Q1 2025, and that's largely driven by the big partnership with CoreWeave. It's really the foundation of their turnaround story.
Okay, so total Q1 revenue was $79.5 million. That's down sharply from $179.3 million in Q1 last year, but that's not necessarily bad news.
Exactly. That's the major insight. This isn't a sign of distress. Management explicitly says this decline is due to the Bitcoin halving, which, cut mining rewards and their intentional operational shift to colocation. CEO Adam Sullivan actually calls this an inflection point. It highlights their move towards what should be a more valuable, stable revenue stream.
Got it. So their key products line up neatly. Bitcoin mining, turnkey hosting, and this high-density colocation, their hyper-core offering, which emphasizes faster deployment for AI clients. And Core Scientific isn't just a player, they're a titan in North American digital infrastructure, right?
Oh, absolutely. They had 19.1 EHs in crypto scale back in March. That's exahashes per second. Basically 19.1 quintillion calculations every second. Mind-boggling power.
But the unique part is the energy.
Yes. Their energy control. Over 1.3 gigawatts of contracted power across their data centers.
Just to put that in perspective, a single gigawatt can power hundreds of thousands of homes. That's enormous scale.
It is. And the CoreWeave deal alone accounts for 590 megawatts of that. That's nearly half their entire contracted capacity dedicated just to that one partnership.
So the main value proposition isn't really Bitcoin anymore.
Not primarily, no. It's the ownership and operational control of this vast, high-powered digital infrastructure. Like CEO Adam Sullivan said, we own and control every structure, every transformer, and every concrete pad. And this gives them a crucial competitive edge. They offer shorter time to power. They can bring high-density AI infrastructure online in months.
Compared to
the 3 to 5 years it can take to build a new greenfield data center from scratch.
So they're repurposing existing sites, brownfield sites.
Exactly, which saves immense time and capital. Think existing land, existing high-voltage connections. It's a huge head start.
Okay, so where do they fit in the wider industry? It sounds like a convergence of big trends.
It really is. First, you've got the post-Bitcoin halving reality. Miners have to diversify to survive. Core Scientific is just way ahead of the curve on this. Second, the AI infrastructure boom. It's just enormous demand for data center capacity for power, especially for those specialized GPUs powering AI.
The kind NVIDIA makes and CoreWeave uses for clients like Microsoft.
Precisely. It's a multi-trillion-dollar market unfolding. And Core Scientific's expertise, built over years managing huge, power-hungry crypto facilities.
Yeah.
Well, it perfectly positions them for AI now.
So who are they competing against? It sounds like they straddle two worlds.
They do. In Bitcoin mining, it's the giants like Marathon Digital,
Right.
Airmiro, and Riot Platforms. Riot, though Mariah has historically had a stronger balance sheet. Core Scientific's differentiator there is that direct ownership and, of course, the pivot to HPC.
And on the HPC data center side.
They're up against traditional data center REITs like Digital Realty, DLR, and Equinix, EQIX, huge established players. But Core Scientific's big advantage is repurposing those brownfield sites. It's faster, it's cheaper than the typical greenfield projects those REITs undertake.
This is like renovating an old factory versus building a skyscraper from dirt.
That's a great analogy, yeah. It creates this valuation puzzle for the market. Are they a miner, a data center provider? Increasingly, the market seems to be emphasizing the HPC side, which makes sense.
And the regulatory side must be complex, too.
Oh, it's a patchwork, yeah. For crypto mining, you've got the IRS, SEC, CFTC, FinCEN for anti-money laundering, plus state-level rules. Texas, Kentucky, Georgia are generally more favorable. For the data center operations, it's local land use, zoning, environmental compliance, Clean Air Act, energy, water usage, plus data privacy like GDPR, CCPA, and even national security reviews sometimes. It's a lot.
What about barriers to entry? It sounds like they're pretty high.
Exceptionally high. First, just getting access to multi-megawatt power contracts like their 1.3 GW. That's a massive hurdle, almost impossible for newcomers. Then there's the capital. A single 100 MW data center can cost over $1 billion.
Wow.
Speed and expertise are critical too. The AI market moves incredibly fast. That 3 to 5 year lead time for greenfield is a killer. Core Scientific's existing sites offer that crucial head start. And finally, just the specialized operational know-how. Managing these high-power, high-uptime facilities, that takes years of experience.
Okay, let's nail down their specific competitive advantages. You mentioned brand strength.
Yeah, they were already a leader in operational scale for crypto mining. But their post-bankruptcy success, plus landing that huge CoreWeave deal, that really cemented their reputation as resilient, credible. They proved they could deliver under pressure.
And cost advantages. Economies of scale.
Definitely. That 1.3 GW capacity gives them scale in energy purchasing, procurement overheads. And repurposing those brownfield sites is just fundamentally cheaper and faster. The big stuff land, high voltage power is already there.
What about switching costs? Not really network effects here, right?
Not traditional network effects, no. But the switching costs for their big HPC customers are monumental. CoreWeave, for example, signed 12-year contracts, moving billions of dollars worth of specialized GPU infrastructure. It's prohibitively expensive and disruptive. That creates incredibly sticky customers. Stable long-term revenue.
And their unique assets and capabilities.
The asset is clear. That 1.3 GW of contracted power across 9 centers in Georgia, Kentucky, North Carolina, North Dakota, Texas. Prime locations often near power sources. The capability. It's that deep expertise. Designing, building, operating high-density, power-intensive digital infrastructure, forged in the fires of 247 Bitcoin mining. That battle-hardened experience is proving invaluable for the demands of AI.
Okay, that paints a really clear picture of the business transformation, which naturally makes you wonder about the people steering the ship. Let's move on to Chapter 2. Management evaluation. This feels really key after the bankruptcy.
It absolutely is. And Core Scientific's current management team, it's a genuine case study in crisis leadership. Think back to late 2022. High interest debt, Bitcoin collapsed, energy costs soaring. They filed for Chapter 11 in December 2022. Looked pretty grim.
But the current team, led by Adam Sullivan since August 2023, they really turned it around.
Turn it around is an understatement. They kept the business operating, cash flow positive during the bankruptcy. But that's incredibly hard to do. Then they negotiated 100% recovery for creditors, significant recovery for equity holders, and emerged in January 2024.
And the debt reduction.
Reduced debt by $400 million immediately, with a clear path to eliminating nearly $1 billion in total debt over time. A massive financial reset.
And you mentioned they secured the CoreWeave deals while bankrupt.
Yes, which is maybe the strongest testament to their leadership and the credibility they maintained. That pivot, securing those deals, would have been impossible without cleaning up the balance sheet first. It showed real strategic foresight, even under immense pressure.
How are they on communication and transparency now? Post-bankruptcy, that's vital.
Seems quite strong. They've got a good investor relations portal, timely press releases, clear SEC filings. Seems like a commitment to transparency. They also strengthened the board. Elizabeth Crane, co-founder of Moelians & Co., joining as chair of the audit committee, is a significant addition. High caliber.
And they were open about executive departures.
Yes, they disclosed Todd Becker's departure and explicitly stated it wasn't due to policy disagreements. That kind of candor helps rebuild trust.
Okay, let's talk capital allocation. What's the focus?
The primary focus is very clear. Disciplined capital-light HPC expansion. And that CoreWeave partnership is just a masterstroke here. CoreWeave funds virtually all the capital needed for site modifications, for the GPU deployment.
So Core Scientific doesn't have to take on huge debt or dilute shareholders for this growth.
Exactly. Minimizes their financial risk massively. Core Scientific only had about $104 million in direct outlay for a recent 70 MW expansion, a fraction of the true cost. Their growth strategy is twofold. Organic, aiming for 300 MW of HPC capacity by end of 2027 at existing sites, and inorganic, looking at targeted M&A for sites that already have power contracted. Smart approach.
Dividends, buybacks.
None. No dividends, no buybacks. And that's absolutely appropriate for where they are. High growth, post-bankruptcy. They need to reinvest every dollar they can into that high-return HPC opportunity.
What about return on invested capital, ROIC? Historically, probably not great.
Historically, it's not meaningful. Past losses, negative equity, bankruptcy distortions, it just doesn't tell you much. The focus has to be forward-looking ROIC. And here, the CoreWeave deal structure is designed for exceptionally high returns. Why? Because CoreWeave puts up most of the capital and Core Scientific gets stable, high-margin revenue with minimal upfront investment from their side. It's textbook capital efficiency.
Yeah.
Okay, that strategic and management context is vital. But to really understand the company's health, we need to connect this to the bigger picture. Let's move to Chapter 3, financial analysis.
Right. Let's start with the key metrics. Market cap. You said around $3.66 billion based on the June 25th close.
That's right, using the $12.30 close. Though, important to remember, it spiked over $5 billion intraday recently on those acquisition rumors. Volatile.
Revenue growth trends, historically volatile, you mentioned.
Very. FY 2024 was $510.7 million. FY 2023, $502.4 million. So fairly flat recently on an annual basis. But Q1 2025 revenue was $79.5 million. That's that big 55.6% year-over-year drop from Q1 2024.
But again, that drop was intentional due to the pivot.
Correct. Intentional shift away from lower margin, volatile Bitcoin self-mining. The future story is all about HPC, those CoreWeave agreements, projected over $10.2 billion in cumulative revenue over 12 years. That's the target. By early 2026, the annualized colocation revenue run rate alone is projected around $360 million. That's where the growth engine is.
Profit margins must be messy during this transition, too.
They are. Gross margin in Q1 2025 was 10%, way down from 43% year prior, if you break it down. Self-mining was 9%, hosted mining 46%. Quite good. And HPC colocation showed only 5%.
Only 5% for HPC. That seems low for the growth engine.
It's misleading. That includes power costs passed through directly to CoreWeave. If you look at their non-GAAP gross margin for HPC, excluding that pass-through, it was 8%. Still maybe lower than you'd expect initially, but likely to improve with scale and as sites fully ramp up.
Operating margin, net margin.
Operating loss of $42.6 million in Q1 2025. But net income was a huge $580.7 million.
Okay, but that net income, that was mostly the warrant thing, right? Not cash profit.
Exactly. overwhelmingly driven by a $621.5 million non-cash gain from warrant revaluation. It's an accounting adjustment based on the stock price surge, not operational profit. The bull case absolutely hinges on HPC scaling to drive operational profitability. Can't stress that enough.
Free cash flow, historically negative.
Historically inconsistent, often negative. It's a capital-intensive business traditionally. Trailing 12 months FCF as of March was negative $171.6 million, Q1 2025. Negative $40.6 million from operations, negative $93.5 million from investing. But again, the new capitalized strategy with CoreWeave is designed precisely to fix this. Turn FCF positive.
Financial stability, earnings consistency.
No history of consistent earnings.
Yeah.
Volatile losses and downturns. That pivot was necessary. The 27.7% average annual earnings decline over 5 years tells that story.
Debt to equity. You said not meaningful.
Not meaningful in the traditional sense, due to that stockholders' deficit of negative $181.5 million. Liabilities still outweigh assets on the books, a hangover from bankruptcy. But the trajectory is crucial. Deleveraging post-bankruptcy, $400 eliminated, path to nearly $1. And the current strategy aims for light leverage going forward, much healthier direction.
But their current ratio looks strong.
Exceptionally strong, almost 5.0, meaning current assets are 5 times current liabilities. So very strong liquidity, lots of cash on hand post-restructuring. Gives them flexibility.
Dividends.
Still none, not applicable right now. All focus on reinvestment.
Okay, valuation. This is the tricky part for a hybrid company like this. PE is useless.
Negative PE due to losses, yeah. Totally useless for now.
But price to sales, that was interesting.
Very interesting. Core Scientific's PS is around 8.9x based on that $3.66 market cap and trailing revenue. What's crucial is comparing that. It's much closer to data center REITs like Equinix at 8.99x PS than crypto miners like Marathon Digital at 7.15x PS.
So the market is already recognizing the shift, pricing it more like a data center company.
It seems so. The market is definitely pricing in that HPC pivot, which is a positive sign for the strategy.
What about intrinsic value, using DCF?
Right. Discounted cash flow. We forecast future free cash flows, discount them back to today's value. It's about estimating what the business itself is truly worth based on expected future performance. Our educational DCF model, based on their plan succeeding, suggests an estimated intrinsic value range of $15 to $22 per share.
$15 to $22, and that's compared to the $12.30 price we're using as a baseline.
Correct. Again, this isn't a price target. It's an estimate of intrinsic worth if they successfully execute the strategy. Big if.
And the key assumptions behind that range.
For revenue growth, it assumes a successful ramp-up of CoreWeave, hitting that $360 annualized colocation run rate by 2026. Also assumes modest growth from new HPC deals and the legacy Bitcoin mining declining as planned. For the discount rate, the WACC, we use a high rate, 12% to 15%. That's crucial.
Why so high?
To reflect the significant risks. The bankruptcy history, the execution risk on the CoreWeave build-out, the general volatility of crypto, and even the AI infrastructure space. You have to build in a margin of safety for those risks.
Okay, fundamentals covered. Let's shift gears. How is the market actually reacting to all this transformation? Let's move into Chapter 4, market sentiment.
Well, Wall Street analyst sentiment is overwhelmingly bullish right now. The consensus rating is strong buy. You've got 95% of analysts rating it either strong buy, that's 56%, or buy, 39%. That's very high conviction.
And price targets.
Average 12-month target is in the $18.14 to $18.33 range. High target is up at $24.15, low around $15.15. So analysts clearly believe in the HPC pivot and, importantly, the potential for that acquisition.
And the news flow,
Yeah.
the media tone, sounds like it's changed a lot.
Dramatically. Think back to 2023, early 2024. All bankruptcy headlines. Now, it's firmly positioned as a turnaround story, an AI infrastructure provider, anchored by CoreWeave. And the most impactful recent news, no question, was that Wall Street Journal report on June 26th about CoreWeave's advanced acquisition talks.
That caused the huge spike.
Over 30% surge in a single day. It completely shifted the market's immediate focus to that near-term catalyst. Is a buyout coming?
That leads us to market indicators. Short interest, you said exceptionally high.
Exceptionally high. 16.21% of the public float. That's roughly 46.7 million shares shorted. And the days to cover ratio is over 5 days.
What does that mean, though? Such high short interest.
It means there's a significant, deeply entrenched disagreement in the market. A real battleground. Bulls see this undervalued AI infrastructure play, maybe an imminent acquisition they're buying. Bears see the bankruptcy history, the execution risk. Maybe they think the CoreWeave deal potential is already priced in, or they're betting the acquisition falls through, they're shorting.
So it's a coiled spring.
Exactly. Very high risk, high reward. Positive news, especially confirmation of a deal, could trigger a massive short squeeze as shorts are forced to buy back shares. Negative news, like talks breaking down, could cause a sharp decline as longs get out and shorts press their bets. Very volatile setup.
What about moving averages, price relative to the 50-day and 200-day?
Before that big June 26 surge, the stock had actually been consolidating around its 50-day moving average. Pretty typical. Now it's significantly above it. That's a classic positive short-term momentum signal.
And the longer-term 200-day?
That's interesting. Around June 13th, the price actually crossed below its 200-day SMA, which was at $11.89. That's usually seen as a bearish long-term signal, but the acquisition news caused it to decisively reclaim that level, so it perfectly illustrates this tug-of-war. A bearish long-term trend potentially being overridden by an explosive bullish catalyst. Very dynamic. That massive short interest really highlights the diverging opinions. It begs the question, who exactly is holding these shares? Who's on each side? Let's look at Chapter 5, Ownership Structure.
Okay, so who owns CORZ? Mostly institutions.
Yes, heavily dominated by large professional money managers. Institutional ownership estimates range from 76% to as high as 88%. Top holders include the giants, the passive index funds like Vanguard with 20.5 million shares, and BlackRock, 17.8 million shares. That's expected. But you also see active hedge funds involved. Names like 2C's Capital, JAT Capital, Clearline Capital have been increasing their holdings. That suggests active managers are buying into the turnaround story.
What about insiders? Management, directors?
Insiders own about 4.86%. Not huge, but significant. And the recent transaction history is interesting. Over the last 3 months, insiders have been net purchasers of the stock, bought over 1 million shares versus selling about 190,000. Net purchase of around 826,000 shares.
Any standout buys?
Yes. Director Yadin Rozov bought 110,000 shares on May 28th. That's generally seen as a pretty strong bullish signal when a director makes a significant open market purchase. There were some officer sales, but looking closer, some were tagged as automatic sells, meaning they were pre-scheduled, likely part of compensation plans, not necessarily reflecting a negative view.
So high institutional ownership, some active funds involved, net insider buying. What does that concentration mean?
Well, it means the stock has the attention of sophisticated investors, which is usually positive. It suggests professionals see potential here. But the flip side is, if one or two of these large funds decide to sell for whatever reason, maybe portfolio rebalancing, maybe a change in thesis, it could create significant downward pressure on the price, purely due to the size of their holdings. It adds another layer of potential volatility.
Right. With such high stakes and that volatility, it's absolutely critical to be clear-eyed about the risks. Let's dig into Chapter 6, Risk Assessment. Maybe start with a SWOT analysis. Strengths first.
Okay, strengths. Number one has to be their own infrastructure and power contracts. That 1.3 plus GW is a nearly insurmountable moat, very hard to replicate. Second, proven operational expertise. They're battle-tested in running these complex, high-density, power-intensive facilities 24/7. They know what they're doing. Third, the strategic pivot itself. Moving to that capital-light HPC model via CoreWeave is just a superior business model. It should enhance returns significantly. And fourth, that battle-tested management team. Successfully navigating Chapter 11 and securing the CoreWeave deal under duress proves their capability. These are real, tangible strengths.
Okay, balancing that out, what are the internal weaknesses?
The legacy of bankruptcy is still there. It creates skepticism, reminds people of past vulnerability, might affect their cost of capital. Their balance sheet is still technically weak with that negative equity, that stockholders' deficit. Compared to established peers like Equinix, they're financially more fragile on paper, even with the improved trajectory. Huge execution risk. They are heavily dependent on successfully converting those large sites for CoreWeave on schedule. Any significant delays or failures could damage that critical relationship. And related to that, customer concentration risk. For the foreseeable future, their growth is heavily reliant on CoreWeave. They need to diversify their HPC customer base over time.
What about external opportunities, the upside potential?
The biggest one is simply the AI infrastructure gold rush. They're positioned perfectly as a picks and shovels provider, selling the essential infrastructure AI needs to run on. Huge market potential. Then there's the obvious CoreWeave acquisition catalyst. A potential takeover at a significant premium is a major near-term opportunity driving the stock. Beyond CoreWeave, there's the opportunity for expansion of HPC hosting. Signing up new AI or other HPC clients plus organically expanding capacity at their existing sites,
Yeah.
and maybe even some upside from Bitcoin. Their legacy self-mining still provides leverage to Bitcoin's price. A surge in Bitcoin could provide unexpected cash flow to accelerate HPC growth even faster.
And finally, the external threats. What could derail this?
Intense competition is a big one. From established data center REITs who have deep pockets and relationships, and also from other crypto miners trying to make the same pivot to AI hosting. It's getting crowded. Energy price and grid stability are constant threats. Higher energy costs hurt self-mining margins and potentially HPC margins if contracts aren't structured perfectly. Grid instability can cause operational outages. Technological obsolescence is always a risk in tech. Faster, more efficient mining hardware could emerge. New computing architectures for AI could change data center needs. They need to stay adaptable.
What about macro factors, interest rates, inflation?
Big impacts. Higher interest rates increase the cost of any future debt and raise the discount rate used for valuation, potentially lowering intrinsic value estimates. Inflation increases operating costs, labor, materials, parts, potentially squeezing margins.
And geopolitical factors, you mentioned tariffs.
Yeah, that's a relevant example. Hypothetical 2025 U.S. tariffs, say 10-25% on key imports, like steel for construction, semiconductors for servers, electrical transformers. That can cause supply chain disruptions, equipment shortages, project delays, and increased costs, especially for any future expansion they have to fund themselves. It's a risk in today's environment. Okay, we've covered a lot of ground. This brings us to our final discussion, Chapter 7, Conclusion.
Let's try to synthesize all of this. Maybe start with summarizing the key points for the bull case. Why would someone invest?
Okay, the bull case rests on a few pillars. One, it's a pure play on AI infrastructure, a direct, highly leveraged way to participate in that massive growth trend. Two, that powerful and defensible moat, the 1.3 plus GW of controlled power, is a truly rare, valuable asset, hard to compete with. Three, the brilliant capital allocation model. Having CoreWeave fund most of the CapEx enables capital-light growth with potentially high returns on Core Scientific's investment. Four, the clear and potent acquisition catalyst. Those CoreWeave takeover talks offer a potential near-term premium payout. And five, a proven and aligned management team that successfully navigated a major crisis and strategically repositioned the company. It's a compelling combination.
But gotta balance it. What's the core of the bear case? Why the skepticism and high short interest?
The bear case highlights. One, it's still a speculative and historically unprofitable enterprise. History of losses, negative book value, relies heavily on future execution, which isn't guaranteed. Two, significant execution and concentration risk, heavy dependence on the CoreWeave build-out succeeding on time and on that single customer relationship remaining strong. Three, the weight of the bear camp itself. That large short interest signals that sophisticated investors see significant flaws or risks. You can't just dismiss that. Four, acquisition and catalyst risk. If those CoreWeave talks fail, the primary near-term catalyst vanishes and the price could collapse significantly. And five, those external threats remain intense competition. Macro headwinds like interest rates, potential geopolitical disruptions like tariffs, all could negatively impact the business.
So bringing it back to valuation, you mentioned the DCF model suggested a range.
Yes, our educational DCF model estimated an intrinsic value range of $15 to $22 per share, based on successful execution, mind you.
And the stock price we anchored to was $12.30 on June 25th.
Correct. So that $12.30 price trades below the low end of our estimated intrinsic value range. What that suggests is potential undervaluation if, and it's a big if, management executes successfully on this strategic pivot. So definitely high risk, high reward. Absolutely. It's starkly high risk, high reward. The outcome really hinges on a few key things. Management's ability to deliver that build out on schedule, whether the CoreWeave acquisition actually happens, and how well they navigate the competitive and macro environment to achieve sustainable profitability. It's likely suitable only for investors with a high tolerance for volatility, a multi-year investment horizon, and pretty strong conviction in both the AI infrastructure growth story and this specific management team's ability to continue the turnaround.
So a final thought for our listeners to chew on. As you consider Core Scientific, maybe ask yourself this. In an era where physical infrastructure, the power, the buildings, is becoming just as critical as the software for AI's growth, is the true durable value now found in the, let's be honest, unglamorous control of raw power and massive data centers? Or is it still primarily in the more speculative swings of the technology companies those centers support? Where does the real value lie long term? We really hope this deep dive gave you a powerful shortcut to getting well informed on Core Scientific. It's a fascinating, complex situation. If you found this valuable, please remember to like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
And for our members, just a reminder, you get priority deep dives on tickers you request for just $4.99 a month. We're actually covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those as they come out. If you just want a one-off deep dive on a specific stock, you can always support the channel by dropping us a super thanks on YouTube. We appreciate it.
Finally, and this is really critical, please remember, this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.